Today, I wanted to share with you a detailed overview of something that's going to affect every real estate professional in the country. FinCEN's new anti-money laundering real estate transfers reporting rule, often called the RRE Rule. Hi, I'm Mike Ridgway, co-founder and CEO of Community Title Network and managing member of Ridgway Law Group. This rule changes how certain real estate transactions must be reported to the federal government. My goal today is to make this simple, clear, and to tell you exactly what matters for your closings. In this video, first I want to take you through the high-level who, what, when, where, and why of this new rule. Then I'll walk you through the important elements so you understand the rule in detail. The FinCEN RRE rule has real complexity, especially when it comes to trusts, layered entities, beneficial ownership, and timing issues that can impact closings. In this video, we'll walk through real-world examples, explain what's reportable and what's not, highlight common pitfalls that can delay closings, and share how agents can prepare buyers early to keep transactions smooth and compliant. So let's talk about when does the new rule go into effect? This rule goes into effect soon, currently expected to be March 1st, 2026. As an aside, the rule's initial start date was December 2025, but it was pushed back for several reasons. And it may be pushed back to a later date again, and time will tell. So what is the RRE rule? FinCEN, the Financial Crimes Enforcement Network, has rolled out a nationwide rule to combat money laundering through real estate. Historically, reporting was limited to certain cities or counties, including many in the Baltimore-Washington corridor. Now, it applies everywhere in the United States. The rule requires settlement agents like us at Community Title Network and Ridgway Law Group to file a detailed report only under the following circumstances. First, residential properties transferred. Second, the transferee is a legal entity or trust. Third, the property is transferred without traditional financing. And fourth, the transfer does not fall under one of the rule's specific exemptions. If even one of these factors is missing, no report is required. So why is FinCEN doing this in the first place? For years, federal regulators have identified real estate, especially all-cash purchases and purchases using non-traditional funding sources made through LLCs and trusts, as one of the easiest ways to hide the true source and ownership of money. When property is purchased through a legal entity, the public record often shows only the entity name, not the individual or individuals behind it. And this lack of transparency has made real estate an attractive target for money laundering, fraud and financial crimes, sanctions evasion, and organized crime and placement of illicit funds. What information must we collect and potentially report? This is the part agents and their customers will see most directly as part of the settlement process. We must review and obtain the legal entity's formation documents, identity verification for each beneficial owner, those who own, control, or are beneficiaries of the entity, a copy of a government-issued ID for every beneficial owner, information about the funds used for the purchase, and the closing documents related to the transfer. The analysis, collection, and reporting of this information is not optional. FinCEN requires complete, verified information, and we as settlement agents must collect it before closing. So how does this affect you as the real estate agent? Here's the good news. You don't have to file anything, but you will play a key role in preparing your clients for what is required and what the process will be. Here's what you can do. Set expectations early. Let entity buyers know they will need to disclose who controls or who benefits from the entity. Encourage buyers to respond quickly when we request documents. Delays in providing IDs or entity information can delay closing. Alert us early if your buyer is purchasing under an LLC or trust. The sooner we know, the smoother the process will be. This is not a commentary on your client's integrity. It's simply a new federal requirement for certain transactions defined by the federal government. So what do we do as the title agent? Our team handles collecting all required data, verifying beneficial owner information, analyzing the information, preparing the official FinCEN report, filing the report within 30 days of closing. And we maintain secure records as required by federal law. We will keep your client compliant and keep the closing timeline on track. And also, please note, this reporting is confidential and goes only to FinCEN. Now that we've covered the high-level purpose of the rule, let's shift gears and walk through the specific elements that determine whether a transaction is reportable or not. It's important to understand that the rule works like a checklist. Every box has to be checked. So first, let's frame what FinCEN actually considers a reportable transaction. Under the rule, settlement agents like us are required to file a report only when all of the following conditions are met. 1. Residential property is transferred. 2. The transferee is a legal entity or trust. 3. The transfer is completed without traditional financing. And 4. The transaction does not fall within one of the rule's specific exemptions. If even one of these elements is missing, no report is required. With that framework in mind, let's start with the first element. What FinCEN means by residential property under the rule. Please note that FinCEN uses a federal definition, not state or local zoning labels. Under the rule, a property is considered residential for purposes of reporting if it falls into any one of 4 categories. First, real property in the United States with a structure designed for occupancy by 1 to 4 families. Think single-family homes, duplexes, triplexes, or 4-unit properties. Second, vacant land in the United States where the buyer intends to build a 1 to 4 family residential structure. There's no required construction timeline. Intent to build is enough. Third, individual residential units such as condos or co-op units designed for 1 to 4 families. Fourth, shares in a cooperative housing corporation as long as the underlying property is located in the United States. Here are important clarifications for real estate agents. The rule does not rely on state definitions of residential property. FinCEN's federal definition controls. A property labeled or marked as commercial can still be reportable if it meets the residential criteria. Mixed-use properties may qualify if there's a residential component that fits the definition. Mobile homes can be reportable if they are designed for residential occupancy, even if the land itself is leased. Planned commercial use is not a carve-out if the property fits the residential definition today. So the key takeaway is this: if the property is or is intended to become a 1 to 4 family residence, it likely satisfies the residential element of the rule, financing. Now that we've established what qualifies as residential property, the next key question is simple. Is the transaction being completed with traditional financing or not? Under the FinCEN RRE Rule, a transaction is only reportable if it is completed without traditional institutional financing. So what does FinCEN mean by traditional institutional financing? It refers to loans made by regulated financial institutions, lenders that are already required to follow anti-money laundering rules, often called AML rules, and they have to file suspicious activity reports, or SARs, with FinCEN. That includes banks, credit unions, institutional mortgage lenders. If one of these types of lenders is involved in the transaction, this element of the rule is not met and no report is required. So what does not count as traditional financing? Think all cash purchases, seller financing, private or personal loans, hard money loans, and loans from private entities that are not subject to federal AML and SAR requirements. Even though money may be borrowed, these transactions are treated as non-financed under the rule. Here's the takeaway for agents. If the lender already reports suspicious activity to FinCEN, the transaction is generally excluded and no report is required. If they don't, the deal may still be treated as non-financed even if a loan exists. That's why telling us early how the deal is being funded and who the funding source will be is now a critical piece of information. Once we know the property is residential and the deal isn't financed using traditional financing, the next question is, who is the buyer under the rule? FinCEN's not focused on the name on the deed, it is focused on ultimately who owns or controls the buyer. And remember, as I said earlier in this video, this is not a commentary on your client's integrity, it is simply a new federal reporting requirement for certain transactions defined by the federal government. When the buyer is a legal entity such as an LLC, corporation, or partnership, there is a requirement to identify the beneficial owners of that entity. An individual is considered a beneficial owner if they either owner control 25% or more of the entity's ownership interests, or exercise substantial control over the entity. This definition aligns with FinCEN's beneficial ownership information reporting rule that already exists. There's no limitation on the number of people reported. If multiple individuals meet these criteria, they must all be reported. An individual exercises substantial control if they, number one, serve as a senior officer, such as a CEO, CFO, or managing member. Two, have authority to appoint or remove senior officers or a majority of the board. Three, have substantial influence over important decisions. Four, or otherwise exercise meaningful control over the entity. Even if no one owns 25% or more, the transaction may still be reportable because individuals with substantial control must be identified. Layered entity structures, such as an LLC owned by another LLC, may also be reportable. In those situations, we focus on the entity taking title and applying the ownership and control analysis to determine who must be reported. If there's a situation that an individual purchases property in their personal name and later transfers it or wants to transfer it to an LLC or trust for no consideration, that transfer can still trigger reporting. So let's talk a little bit about trusts. There is a limited exemption for certain spousal estate planning transfers, but there's no general exemption for transfers to entities or non-exempt trusts, including most family trusts. Trusts are fully covered under the rule. When the buyer is a trust, FinCEN requires us to identify the individuals behind the trust who own, control, or benefit from it. And this can include any trustee or individual with authority to dispose of trust assets, a beneficiary who is the sole permissible recipient of income and principal, or who has the right to demand or withdraw substantially all trust assets, the grantor or settler of a revocable trust, or an individual who is the beneficial owner of an entity or trust that holds one of these roles. There is no blanket exemption for family trusts, estate planning trusts, or trusts where the original grantor has passed away. The key takeaway for real estate agents working with buyers who are legal entities or trusts is this: the rule looks beyond the name on the contract and asks three questions. Number one, who owns it? Number two, who controls it? And number three, and who benefits from it? Early disclosure of buyer structure allows us to collect the required information, obtain the necessary certifications, and keep transactions moving smoothly so that we can close on time. At this point, a common question comes up. How are settlement agents expected to gather and verify all of this ownership information without turning every closing into an investigation? That's where the rule's reasonable reliance standard comes in. FinCEN recognizes that title and settlement agents are not law enforcement and are not expected to independently investigate or audit a buyer's ownership structure. Instead, the rule allows us to reasonably rely on information provided by others, as long as we do not have knowledge of facts that would reasonably call that information into question. In other words, we can rely on information provided during the transaction unless there are red flags, inconsistencies, or known facts suggesting the information may be inaccurate. However, when it comes to beneficial ownership for legal entities and trusts, the rule applies a narrower standard. In those situations, we may rely only on information provided by the transferee or the transferee's authorized representative, and only if that information is certified in writing as accurate to the best of their knowledge. This certification requirement is important because it shifts responsibility for the accuracy of ownership information to the buyer while still allowing settlement agents to comply with the rule without independently verifying complex ownership structures. For real estate agents, the takeaway is simple. Early disclosure and cooperation matter. When buyers provide accurate information and certifications up front, we can rely on that information, avoid delays, and keep the transaction moving smoothly. With the buyer identified and beneficial ownership addressed, the final step is determining whether the transaction falls under one of the rule's specific exemptions. This is important because exemptions under the FinCEN RRE Rule are limited and narrowly defined. A transaction is not exempt simply because it involves family members, estate planning, or a non-sale transfer. An exemption applies only if the transaction clearly fits within the rule. Under the RRE Rule, reporting is not required for certain categories of transfers, including transfers to or from a governmental authority such as federal, state, local, or tribal government entities. Transfers that occur by operation of law due to the death of an individual, such as certain estate distributions to heirs or beneficiaries. Certain transfers between spouses, including transfers incident to divorce or specific estate planning transfers between married persons. Another exemption is transfer made pursuant to a court order, such as those resulting from foreclosure, bankruptcy proceedings, or similar judicial actions. And certain transfers involving secured creditors where title passes as part of enforcing or releasing a security interest. It is equally important to understand what is not exempt. There is no broad exemption for family trusts, no general exemption for transfers to LLCs for asset protection. There's no exemption for gratuitous transfers made for planning purposes, and no exemption simply because a property has been held for a long time, the transfer is for no consideration, or the transfer is labeled as commercial or internal. If the transferee is a legal entity or trust and the other elements of the rule are met, reporting may still be required unless a specific exemption clearly applies. Because exemptions are fact-specific and narrowly applied, early identification is critical. Flagging a potential exemption early allows us to evaluate it carefully and determine whether reporting is required before the transaction reaches the closing table. The key takeaway for real estate agents is this: exemptions are the most technical and often the hardest part of this rule to incorporate into daily practice. They are nuanced, fact-specific, and not always intuitive, especially when transactions involve family members, estate planning, or internal transfers. That said, exemptions are also critically important to identify early. If a transaction involves residential property, is not traditionally financed, and includes an entity or trust, it should be treated as potentially reportable unless a specific exemption clearly applies. So from a practical standpoint, the best approach is not to try to solve the exemption analysis yourself. Instead, flag these transactions early and communicate openly with your settlement agent. Early notice allows us to evaluate the facts carefully, determine whether an exemption truly exists, and address compliance well before the closing table. Early communication protects everyone involved, the buyer, you as the agent, and the title company, and helps ensure transactions close smoothly, on time, and in compliance with the rule. When in doubt, raise the question early. That one step can prevent delays, confusion, and last-minute issues. So one more critical piece to cover is this: what information actually gets reported? This matters so agents and buyers know what to expect and understand why we, as settlement agents, ask for it. Many delays and frustrations come from surprise. When buyers understand upfront what information is required, the process is much smoother. Under the FinCEN RRE Rule, the information reported falls into three main categories. 1, information about the property. 2, information about the transaction. And 3, information about the individuals behind the buyer. First, we are required to report basic information about the property and the transfer itself. This includes property address, the type of property being transferred, the date of closing, and information about how the property is being transferred. Second, we must report details about the transaction structure and funding. This includes the purchase price and whether the transaction is completed without traditional institutional financing. This information helps FinCEN understand how funds are moving into real estate transactions. The third and most sensitive category is beneficial ownership information when the buyer is a legal entity or a trust. For legal entities, we must report identifying information for each beneficial owner. That typically includes the individual's full legal name, date of birth, current address, and a copy of a government-issued identification document that is valid. We must also identify whether that person owns or controls 25% or more of the entity, or exercises substantial control over it. For trusts, we must report information about the individuals who control or benefit from the trust. This can include trustees or individuals with authority to dispose of trust assets, certain beneficiaries, and in the case of revocable trusts, the grantor or settlor. The goal of FinCEN is to identify the real people who have authority over or benefit from the trust assets at the time of transfer. In addition to identity information, FinCEN requires us to document how the funds are being provided and to maintain records supporting the information reported. It's also important to understand what this process is not. This information is not public, not recorded in the land records, and not shared with real estate agents or sellers. It is reported confidentially by us as settlement agent to FinCEN for regulatory and law enforcement purposes. From a practical standpoint, that is why we ask buyers for entity documents, trust documents, identification, and written certifications. These requests are not discretionary. They are required so we can accurately complete the report and comply with federal law. For agents, the key message to convey to buyers is simple. If they are purchasing residential property through an entity or trust without traditional financing, they should expect to provide ownership and control information early in the process. Preparing buyers for that reality upfront helps avoid last-minute surprises and chaos and keeps closings on track. It's important to understand who FinCEN expects to file the report. The rule is very clear. Only one entity or person is responsible for reporting in any given transaction. That responsibility is determined in one of two ways: through a defined cascading hierarchy set out in the rule, or through a written designation agreement among the parties involved. Under the hierarchy, primary responsibility rests with the closing or settlement agent due to direct involvement in the transaction. If there is no designated settlement agent, responsibility moves to, in priority, the person preparing the settlement statement, then to the party filing the deed, then to the title insurance underwriter. If none of those roles apply, the rule looks next to the entity dispersing the largest amount of funds, then to the person evaluating title, and finally, to the party preparing the deed or transfer documents. The purpose of this hierarchy is simple: to ensure that someone is always responsible for reporting. Responsibility does not disappear just because roles overlap or are unclear. The rule also allows parties to use a designation agreement. This is a written agreement identifying one specific person or entity as the reporting party. Designation agreements can provide clarity, reduce duplication, and help streamline compliance, particularly in complex transactions. For real estate agents, the takeaway is this: FinCEN has intentionally placed reporting responsibility on professionals closest to the transaction. That structure is why settlement agents approach compliance carefully and why early communication about deal structure is so important. It's important to address a practical reality of this new rule: the additional responsibilities, time, and liability imposed by the rule on settlement agents. Under the FinCEN RRE Rule, our role has expanded significantly. As settlement agents, we are now required not only to close the transaction, but to do the following: analyze whether it is reportable, determine who the reporting person is, identify beneficial owners, collect and document sensitive information, obtain written certifications, evaluate and analyze potential exemptions, and file a detailed federal report accurately and on time. This is not a clerical task. It requires careful analysis, reasoned judgment, additional communication with buyers and agents, secure handling of sensitive information, and ongoing record-keeping obligations. It also places direct regulatory liability on us as the settlement agent if the analysis or reporting is incorrect. As a result, compliance with this rule requires meaningful additional time, resources, and infrastructure. That includes training staff, enhancing procedures, and maintaining secure systems to meet the elevated compliance requirements. Because these responsibilities and risks are imposed by federal regulation, there will be situations where we must pass along additional compliance-related costs to the buyer when a transaction is subject to reporting. These costs reflect real work and real liability. They are not discretionary or arbitrary. We understand that no one welcomes added steps or added costs, and at the same time, we have a legal obligation to comply with this rule consistently and thoroughly. We cannot cut corners, make exceptions, or absorb unlimited regulatory risk on behalf of the transaction. Our commitment to agents and to buyers is transparency. When a transaction triggers reporting, we will communicate early, explain what is required, outline any additional costs up front, and work efficiently to keep the closing on track. This is another reason early identification and communication matter. The sooner we know a transaction may be reportable, the better we can manage timing, expectations, and costs for everyone involved. It's also important to understand the penalties associated with this rule and why settlement agents are approaching compliance so carefully. Under the FinCEN RRE Rule, settlement agents are being assigned a new and expanded federal compliance responsibility. For the first time under federal law, settlement agents are responsible not only for closing the transaction, but for now determining whether federal reporting is required and for submitting a complete and accurate report when it is. Failure to file a required report, filing late, or submitting incomplete or inaccurate information can result in civil penalties for the settlement agent of up to $10,000 per violation, and in some cases, penalties that accrue per day until the issue is corrected. Where there is willful failure, intentional avoidance, or knowing submission of false information, exposure increases significantly. In those situations, penalties can include enhanced civil fines, regulatory enforcement actions, and potential criminal liability, including fines and possible imprisonment. Importantly, these penalties apply to the reporting person. Under the rule, that is typically the settlement agent, not the buyer, seller, or real estate agent. This means the legal and financial risk sits squarely with us as the settlement agent responsible for the reporting decision. Because this is a new federal obligation, it requires a higher level of diligence, documentation, and consistency than was previously ever required. These penalties are not theoretical. FinCEN has a long history of enforcing similar rules in other industries, and this rule extends that enforcement framework into real estate. This is why we must apply the rule uniformly, cannot make exceptions, and require complete and timely cooperation when a transaction is reportable. Early identification and early communication are critical to managing this responsibility and keeping transactions on track. So to wrap up, today we covered how FinCEN's real estate reporting rule works and what it means in practice for real estate professionals. We walked through how a transaction is evaluated, whether the property is residential, how it's financed, who the buyer is, and whether any narrow exemptions apply. We discussed beneficial ownership, reporting responsibility, and the real obligations and penalties now placed on settlement agents. The key takeaway is simple. Early identification and early communication matter. When entity structures, trusts, non-traditional financing, or potential exemptions are flagged early, transactions move more smoothly and avoid last-minute issues and potentially chaos. At Community Title Network, our role is to help you navigate this new regulatory landscape with clarity, consistency, and confidence. If you have any questions, want to walk through a specific deal, or would like additional guidance for your team, reach out early. We're here to help. We look forward to continuing the conversation and working together to keep closings compliant and on track.